the damn thing itself is leveraged, or I can even do it in the markets, overall index. Suppose TQQQ. Okay? This is an ETF. I know it's a leveraged product. Roughly speaking, uh, ETF for NASDAQ 100 index. These are essentially 100 largest stocks in NASDAQ. I mean, they're responsible probably for 90% of NASDAQ value anyway. Even the top 10 is responsible for at least 40% of NASDAQ value. If NASDAQ 100 index, which is called the QQQ, if it goes up by 1%, this ETF roughly goes up by 3%. Okay? There's even a short version of this. It's called SQQQ, of course. You can even bet the other way around. Now, of course, these guys handle that sort of stuff using the futures markets because of the indexes. But as market goes down, and let me see if there's even leverage I can do on this. Apparently, I did some transactions on this a while ago. I don't think there is any. But as the market goes down, when people are trying to get out of these amplify the effect. So it increases volatility. So you guys have to distinguish between day trading and investing. Those are two different activities. Investing, whatever your reasons may be, you believe in a stock, you identify what's a good value for that. Just because I like a stock does not necessarily mean I'll buy it at that price. I mean, I like NVIDIA, but if NVIDIA was trading at $200 right now, I would have dumped all my options. I would have made some money. I still think it's probably worth $300 a share, but the upside is not that much anymore for me. I can go find other stuff. Or I may not even like a company. Does that mean I'm not going to buy that company? You know, you're not buying a girlfriend or a wife, okay? You're buying an investment. Your stocks do not love you back or do not hate you back. All you want to do is make money. You may have your own individual value judgments. You know, some people don't want to buy tobacco products. If that's what you want to do, that's your business. I mean, I already paid them a lot of money with my consumption, so I don't buy tobacco products, and I don't see a big future in them anyway. But if I did, it would never no issue at all. I don't like the Chinese stocks too much. That doesn't mean I'm not going to buy Alibaba. As you guys know, I don't have too much love for either Donald J. Trump or Elon Musk. That doesn't mean I'm not going to buy their stuff. I mean, they're kind of killing themselves, but why would I let that stop me from making money if I can see a way to make money? I mean, example, I still think they're too expensive, but let's see what happened to Tesla stock over the last 3 months. It's down 42%. A lot of it is self-inflicted wound by Elon Musk, especially with what they're doing right now. Again, this is independent of what you think of this politically. Market perceives that as negative. People stop buying Teslas. I mean, they're expensive to begin with. We can argue technically whether that's justified or not. That's a different issue. But people are not buying it. China's wasn't buying it too much anyway. Europe stopped buying it. Obviously, Canadians and Mexicans are not going to buy it. And who were the biggest consumers of Tesla in the United States, politically speaking? Do you really think that redneck Republicans were after Tesla? Again, independent of your political beliefs, they Americans love gas guzzlers for a lot of different reasons. So Republicans were not buying, at least Trump supporters, I should say, were not buying Tesla to begin with. Now that Elon Musk pissed off a lot of liberals, pinko commies like me, they're not going to buy Tesla either. I mean, I took a lot of Ubers in them. They're great cars. I'm not sure they're worth that kind of money, but they're great cars. But this guy is simply, he lost about $120 billion in his wealth during the last 3 months, not including all the stuff that's going on with SpaceX as well. If it's only his own wealth, I don't mind. That's his problem. Trust me, he can live with $50 billion. But he does not own majority of the Tesla shares. Tesla shareholders are, very much being killed over. So markets can do really irrational stuff. All right, let's talk a little bit about. I mean, we did talk about valuation using PEs and stuff. I actually want to talk a little bit about some market-wide measures to figure out, at least to think about, whether or not markets are cheap, overrated, or not. Just like the PE measures we have for individual stocks, we also have similar measures for indexes. One of them is S&P 500. I actually use this website, maltpl.com. Nothing special about it, but there is a lot of collated information. It's already there. For example, let's look at the S&P 500 PE ratio. You can think of S&P 500 basically as a conglomerate that has 500 companies in it, and the shares are based on their market values. So you can actually calculate the price of the conglomerate. You can calculate earnings per share, which just gives you the what you want to call the PE ratio. And we have data since 1871, right? I mean, this thing went as high as, this is June 2009, 101, okay? On the other hand, right now it's about 27. Okay? Again, if we take things literally, this means if the current earning levels of S&P 500 would remain at that level, the entire market would pay you back within 27, 28 years. That's pretty high. I mean, if you look at the historical numbers, the mean is 16, median 15. The lowest ever was 5. That's December 1917. That's slightly a few months after the U.S. went into the First World War. But there are also cycles to these things. I mean, let's look at here. Right after the war, it was low, and the market rallied, and they were followed by declines. One of the biggest crashes was about here. That's the so-called Nasdaq bubble, dot-com bubble. The trouble with PE ratios, A, as we talked about, they are backward looking, and B, uh, because of accounting practices and variable nature of the economy, they tend to be volatile. So there is a Nobel Prize winner economist, Robert Shiller. He came up with a different concept. He said, instead of dividing the price by last year's earnings, let's do the following. Let's calculate inflation adjusted average 10-year earnings in the past. So let's get the current price and divide it by what you want to call average earnings. And he actually gave this name. The nickname he gave this is a CAPE. It's short for cyclically adjusted PE ratio. Why, at least historically, business cycles tend to last, the peaks and the valleys tend to last around 8 to 10 years. It's a little bit longer these days, but the last 100 years, that's just kind of like that. As you can see, these patterns are a lot more smooth. Why we're averaging things. But whenever these Shiller PE ratios are too low, too high, almost always they're followed by big declines. Of course, markets, let's look at it here. This is April 1929, about 6 months before the big crash in 1929. Shiller PE ratio was 27. Okay. Guess what happened within 4 years? 7. That means on an earnings adjusted basis, market declined almost 75%. Same thing here. This is early 80s, very cheap, partly because of all the shenanigans that was going on in 1970s, both politically in the United States and geopolitically with the oil shocks and all sorts of stuff. And we started having a growth. Look at the April 2000 PE ratio, 41. That's very high. Yes. Oh, okay. But that was followed by a big tanking again.